Hey everyone, and welcome to this explainer. Today, we're going to break down the highly anticipated 2026 AI investing landscape and really build out a research-backed blueprint for your own portfolio. Because let's face it, artificial intelligence, it's no longer just some futuristic concept. It's actively transforming industries and driving unprecedented economic growth right this second. So today, we're diving deep into the companies that are actually proving their monetization strategies. That way, you can confidently participate in what is arguably one of the biggest productivity shifts in human history.
Now, you might be looking at the massive market caps of today's tech giants and wondering, is it too late? Has the train already left the station? And you know what? It's a completely valid question. But let's unpack why the real opportunity is honestly just beginning. We're transitioning from that early adoption phase into massive global integration. And for us as investors, that means shifting our focus toward established companies with strong fundamentals and proven track records.
So here's our roadmap for today. We'll start with the state of AI in 2026. Then, we'll analyze four main pillars: NVIDIA, Microsoft, Alphabet, and Broadcom. Finally, we'll wrap the whole thing up with a highly actionable portfolio strategy.
All right, Section 1, the state of AI in 2026, moving from hype to revenue. We are officially past the initial hype phase. And to put that into perspective, we're talking about hundreds of billions in global AI capital expenditures through 2027. Tech giants, often called hyperscalers because of their massive cloud networks, so companies like Microsoft, Amazon, Google, and Meta, they are relentlessly pouring capital into data centers and chips. This isn't just speculative spending anymore. They're establishing the absolute bedrock for long-term growth, creating a massive runway for the ecosystem partners who supply them.
So the crucial takeaway here is that we're specifically looking for blue-chip leaders with strong balance sheets and competitive moats. Think of it like looking for heavily fortified castles, not speculative paper boats just getting tossed around by market noise. We want companies with recurring revenue models and high barriers to entry. And sure, some valuations have moderated recently because of those massive capital expenditures, but that actually creates potential entry points for patient investors who are willing to look past the short-term bumps.
Moving on to Section 2. NVIDIA, the AI chip king.
NVIDIA isn't just participating in the AI boom, they're literally enabling it from the ground up. Their market cap is exceeding an astronomical $4.9 trillion, and their share price, hovering around $200 to $207, is backed by massive scale, driven by their next-generation Blackwell chips. Those chips are fueling an estimated $320 to $330 billion in data center revenue alone. It's this incredible virtuous cycle. Right? Larger AI models require more compute, which directly requires more NVIDIA hardware. Oh, and they even offer a tiny dividend yield between 0.02 and 0.5%. Now, you do have to weigh the scales here. Yes, you might face some short-term volatility and an elevated forward PE ratio. But look at the flip side of that equation. A massive $90+ billion in free cash flow. That easily justifies its dominance as a pure-play infrastructure pillar, and it builds an incredibly deep ecosystem moat. If you're bullish on AI infrastructure, this kind of moat is, well, it's pretty much impossible to ignore.
Okay, Section 3, Microsoft, the enterprise AI powerhouse.
Microsoft is kind of the perfect beginner-friendly giant. They're integrating AI across absolutely everything, from Azure to Copilot to GitHub. By Q3 of fiscal year 2026, total revenue hit $82.9 billion, up 18% year over year. Cloud revenue was $54.5 billion, up 29%. But honestly, the craziest part? A $627 billion commercial backlog. In simple terms, that is practically guaranteed future revenue as they lock enterprise clients into their ecosystem for years to come. Plus, you get a solid 0.9% dividend yield, coming in at about 91 cents a quarter. And the speed of adoption here is just staggering. Microsoft's AI business alone surpassed a $37 billion annual revenue run rate. That's up an incredible 123% year over year. They aren't just talking a big game about AI, they're actively proving the return on investment to enterprises and reaping the massive financial rewards right now. Now, some investors do get a bit nervous when they see near-term guidance like $190 billion in capital expenditures for 2026, but remember our macro view from earlier? This spending builds durable infrastructure that funds a highly reliable, long-term dividend. It's a fantastic set-it-and-forget-it holding, backed by a history of 9 to 10% annual dividend growth over the past decade.
Let's jump into Section 4, Alphabet, focusing on search and cloud innovation.
Alphabet gives you beautifully diversified exposure at a very reasonable price, fueled by their custom AI chips or TPUs. For Q1 2026, total revenue hit roughly $110 billion, which is up 22%. But their cloud revenue, that surged 63% to $20 billion. Add in a massive $462 billion backlog and a forward PE sitting in the mid-20s to 30x range, and it's heavily viewed as discounted compared to its historical averages, making it a super attractive entry point.
Similar to Microsoft, Alphabet is heavily watering its future seeds, expecting about $180 to $190 billion in 2026 capex. While that definitely pinches free cash flow today, it's directly cultivating long-term leadership. It protects their resilient core search monetization while simultaneously sprouting multiple completely new growth vectors and enterprise tools.
Section 5. Broadcom, the leaders in custom AI networking.
Broadcom completely dominates the crucial background plumbing of this whole revolution through their custom AI chips and high-performance networking. We're talking about a market cap over $1.5 trillion. But the really key metric here is their AI revenue share, which is now exceeding 40% of their total business. Toss in a 0.7% dividend yield, and they serve as the absolute ideal diversified semiconductor complement to a powerhouse like NVIDIA.
Of course, their fortunes are definitely tied to those hyperscaler spending trends we just talked about, so that's a concentration risk you do need to keep in mind. However, Broadcom balances this out by offering extremely reasonable multiples, highly diversified networking demand, and an attractive yield on cost over time. For a patient investor, that dividend payout relative to your original purchase price becomes incredibly attractive the longer you just hold on to the stock.
All right, Section 6, building your AI portfolio. Let's pull all of this macro data and company analysis together into an actionable framework. For a great beginner allocation model, you could anchor the portfolio heavily with Microsoft at 40% for that defensive software stability. Then push for pure play growth by allocating 30% to NVIDIA. You can diversify into search and cloud with 20% in Alphabet, and finally, grab those vital networking yields with 10% in Broadcom. It's a highly balanced, incredibly robust approach.
To actually execute this, you've got to mitigate the inherent volatility of the AI sector. First, pick 3 to 5 core Nasdaq or NYSE leaders. Second, use dollar-cost averaging, which just means investing a set amount of money at regular intervals to completely smooth out the peaks and valleys and take the emotion right out of it. And third, hold for a strict 5 to 10+ year horizon, just rebalancing annually to stay perfectly on track.
Now, if you want to widen the net slightly beyond those 4 pillars we just covered, we've got some honorable mentions. Established giants like Amazon with AWS, Meta platforms dominating ads and AR, and Oracle with their cloud databases. They all offer incredibly strong, resilient ecosystems that are massively benefiting from these same AI tailwinds.
The AI productivity shift is absolutely still in its early innings. The companies proving their ability to monetize and drive efficiency today are the exact ones that are going to thrive over the next decade. So ask yourself, which of these blue-chip leaders will anchor your long-term portfolio? Dig into the data, stay patient, and build your future. Thanks for hanging out with me on this explainer, and keep learning.